IAS 12, Video 2. Now before we continue with this video, did you watch Video 1? Do you have the warm fuzzy feeling regarding current tax calculations? Okay, good. Then we can continue with this video. In this video, we will be looking at the current tax theory from IAS 12. So you need to have your IFRS book open in front of you and follow in the paragraphs in IAS 12 with me as we go along. Okay, so first of all, the structure of IAS 12 and the paragraphs that refer to current tax are as follows. So firstly, we have the objective, the scope, and the definition. So what we are going to look at specifically with regard to these paragraphs is I'm going to tell you a little bit more about foreign tax. Next, we will be looking at the recognition of a current tax liability or asset. And here I am going to bore you because I'm going to tell you something that you already know. Next, we are going to look at the measurement, presentation, and disclosure. And when it comes to measurement, I am going to tell you how we measure current tax when there is a change in the tax rate. With regard to presentation, I'm going to show you that we can also have tax in other comprehensive income. And then when it comes to disclosure, I'm going to show you that there's a part of the note that you have not seen before, but you will have to wait for the next episode to see exactly what it looks like. So firstly, let's look at the scope of IAS 12. So the scope of IAS 12 tells us that income taxes will include all domestic and foreign taxes, and that it will also include any withholding taxes. So withholding taxes just means the tax is held back before the amount is paid over. So what is foreign tax? Let's look at this example. A company received foreign royalty income of 18,000 Rand. So that's the amount that was received by our company. In terms of a double taxation agreement, no South African income tax is payable on this amount, but 10% withholding tax was withheld by the foreign company. Okay, so what was the actual amount of foreign income that we actually earned? So we know what the amount was that we received, and we know what the percentage was of the withholding tax that was withheld. So the calculation will be our actual income amount less the withholding tax will give us the amount received, which is the 18,000 Rand. So because our withholding tax is calculated at 10%, it means that our income amount will be 100%, and our 18,000 that we received will be the 90% after the withholding tax has been deducted. So the 100% will be the amount that will go into the splokkie as income. The 10% will be will go to our tax expense in splokkie because that's part of it's included in the scope of IAS 12 as income taxes. And then the 90% will be the 18,000 that we actually received in cash. So what will the journal entry be for this foreign income and foreign tax? We will debit the bank with the 18,000, debit the income tax expense with a foreign tax of 2,000 Rand, and we will credit the foreign royalty income or whatever type of income it was. So in our note where we disclose our income tax expense, what it's made up of, the main components of the income tax expense, we now have this additional line for the foreign withholding tax. Next, we look at the recognition of the current tax liability or asset. And remember, I did warn you that this is going to bore you because I'm going to tell you something that you already know. Paragraph 12 of IAS 12 tells us that current tax for the current and prior periods shall, to the extent unpaid, be recognized as a liability. Shocker, If we have not yet paid it, it will be recognized as a liability. And if the amount already paid for these taxes exceed the amount due for those periods, then the excess shall be recognized as an asset. So if we have an amount that is unpaid, it will be a liability, and if we have paid too much, it will be recognized as an asset. Next, we look at the measurement of current tax. Now, obviously, up to now, measurement has not been a problem. We've just multiplied our taxable income with 28%. But what happens if there is a change in the tax rate? Paragraph 46 of IAS 12 tells us that current tax liabilities or assets for the current and prior periods shall be measured at the amount that is expected to be paid to or recovered from the taxation authorities. And to calculate this amount, we will use the tax rates that have been enacted or substantively enacted by the end of the reporting period. So what is the tax rate that has been enacted or substantively enacted by the end of the reporting period? So what does substantively enacted mean? First of all, what is enacted? Enacted means it has been published in the Government Gazette, it's been signed off by the President, and it is now included in our legislation. It's part of our Income Tax Act. Substantively means it's the same in substance, so it's essentially the same. So substantively enacted means it is as good as if the change has already been signed off by the President and it's been published in the Government Gazette. So in paragraph 48, they give us some guidance on this substantively enacted. They say that, first of all, we will usually measure our current and deferred tax assets and liabilities using the tax rates that have been enacted. However, in some jurisdictions, announcements of tax rates and new tax laws by the government have the substantive effect of actual enactment. So announcement where the budget, for example, in the budget speech, where it said that the tax rate will change, might have the substantive effect of actual enactment. So even though it's just been announced in the budget speech, it might substantively be the same as if it has already been enacted. Even though the actual enactment will only happen afterwards, after a period of several months. And if this is the case, then IAS 12 says we will measure our tax assets and liabilities using the announced tax rate. So then when it's substantively enacted, we'll use that rate even though it has not yet been enacted and included in the legislation. So let's put that into practice in South Africa. This year, on the 24th of February, Minister Tito Mboweni announced a change in the corporate tax rate. So this will be signed into law on a future date. So now on a future date, the President will put his signature on this change in legislation, and it will be signed into law. So then on that date, it will be enacted. However, it might be that on the 24th of February, when the minister made the budget speech and announced the change in tax rate, it would have been as good as if it has already been enacted. So it might be that it has been substantively enacted. In order to determine whether this announcement of a change in the tax rate is a substantive enactment of the change, SAICA has provided us with guidance in the form of the Financial Reporting Guide 1, or FRG 1. And you will find FRG 1 in your SAICA handbook. FRG 1 says that When we have to make this decision whether an announcement is the same as is actually a substantive enactment of the change, we have to ask ourselves first whether this change that has been announced is inextricably linked to a change in the tax law. So the change in the tax law will be when the President signs this change. And if the announcement there is a link that cannot be broken to when the tax law will be changed, then it means that we will not have a substantive enactment date. We will actually have to use the date that it is actually enacted, which is the date that it's signed by the President. However, if the answer is no, there is no link between the announcement of the change and the change in tax law, then it means that the date of the speech will be our substantive enactment date. So if we have this inextricable link between the announcement of the change and the change in the tax law, it means that we will not have a substantive enactment. We will have to wait until it has actually been enacted and signed off by the President. However, if we do not have this link, then the date of the announcement of the change will be our substantive enactment date. Now note that this is not the effective date. So like Minister Mboweni announced on the 24th of February that the tax rate is now going to go down to 27%, it does not mean that all companies are now going to pay 27% tax from the 25th of February. The Minister had also announced what the effective date will be, which is then a future date. We are only now determining whether this announcement is actually as good as if the tax law has already been changed. Okay, let's look at class example 1 in your notes. So in your notes and class examples document, we are now looking at class example 1. And you will see in this example, we have a change in the tax rate from an old rate of 29% to 28%. That give us the date that the Minister announced this change, the 23rd of February. And they also give us the effective date, tell us that for all entities with the years of assessment ending on or after the 1st of April 20x12. Now in a question, or in a test or exam, I have to tell you whether this change, the change in tax rate that was announced by the Minister is inextricably linked to a change in tax law or not. So I have to tell you that, but you then have to know what you should do when it is inextricably linked, which is wait for it to be enacted, or when it's not inextricably linked. Okay, so has it been, we have to determine when has it been substantively enacted and when is it effective. Those are the two dates that we are worried about now. Okay, so the next sentence in this example tells us that this tax rate change is not inextricably linked to the changes in the tax law. So the announcement of the change is not inextricably linked to the change in the tax law. So therefore, we do not have to wait until it actually becomes enacted, this change. We can actually work off the date that it has been substantively enacted, which in this case will be the 23rd of February 20x12 because it is not inextricably linked. Okay, and next we also know what our effective date is. That is the 1st of April 20x12. So in this example, they give us 3 different financial year ends, and we now have to determine which rate we should use, the old rate or the new rate, to calculate the current tax expense and liability for the year. So for the first one, 31st of December x11, we see that the substantive enacted date as well as the effective date is after year end, which means it's only going to happen in future. The rate that has been enacted or substantively enacted at year end will still be the old rate of 29%. The next financial year end is the 28th of February 20x12. And here we see that the substantive enacted date, which is the 23rd of February, falls before the 28th of February. However, the effective date is after. So we have to use the rate that we expect to pay, which has been enacted or substantively enacted by the end of the reporting period. So even though this rate has been substantively enacted, it is only going to become effective later. So the rate which we expect to pay our taxes for this year will be the old rate of 29%. Okay, and then lastly, if our financial year end is on the 30th of April 20x12, then the substantive enacted date as well as the effective date falls before this financial year end, which means that the rate is already effective at year end and it has been substantively enacted, which means we will use the new rate of 28% to calculate the current tax liability for this financial year. Okay, next we look at presentation. And here I want you to look at paragraphs 57 and 58. Now you'll see in this paragraph 57, they tell us that accounting for the current and the deferred tax effects of a transaction is consistent with the accounting for the transaction or the event itself. And then in paragraph 58, they say current and deferred tax shall be recognized as income or an expense and included in profit or loss for the period, except when this transaction or event that causes the tax is recognized in the same or a different period outside profit or loss, either in other comprehensive income or directly in equity. So the default is for tax to be recognized in profit or loss. However, if the transaction itself that gave rise to this tax was recognized outside of profit or loss, like in other comprehensive income or directly in equity, then we will account for the tax in the same place. So the tax follows the actual transaction. If the transaction was in P&L, the tax will be in P&L. If the transaction was in OCI, then the tax will be in OCI. And the same for items directly in equity, our tax will also be directly in equity. As well as there's also an exception if the tax arises from a business combination, which we will look at later in the year when we do consolidations. Okay. So if we look at our SPLOCkie and the presentation of income taxes, you'll see that we have our profit or loss items here at the top. So those are all the transactions that affected profit or loss. And then the income tax on these profit or loss items, we also show as part of profit or loss. However, if we have other comprehensive income items, for example, the revaluation of property, then we will show the tax on these OCI items in OCI. So we have looked at presentation on the SPLOCkie. Now we are looking at presentation on the statement of financial position. Now, if we have a situation such as this, where we have an amount that's payable for income tax regarding the current year, and an amount receivable because of an overpayment in the prior year, are we allowed to offset that? Now we know that IAS 1 says that we are not allowed to offset unless a specific standard gives us permission to do so. And IAS 12 in paragraph 71 does give us permission to offset this debit and the credit, the asset and liability, if the entity has a legally enforceable right to offset. So that means to offset the debit against the credit, and if the entity intends to settle on a net basis. So if we intend to pay the receiver only the net amount of this asset and liability, then we have the intention to settle on a net basis. So when do we have this legally enforceable right? So we will only have this legally enforceable right if these taxes are levied by the same taxation authority. So if they are levied by different taxation authorities, we will not have the right to offset this debit and credit. Okay, and then in a group situation, in our consolidated financial statements, paragraph 73 tells us that it might be that we might have a legally enforceable right to offset. However, we have to remember that in a consolidated financial statements, we are actually working with two separate entities. Therefore, in a group situation, we will not be able to offset. So in South Africa, because we have only one tax authority, if we're looking at the financial records of one entity, then we can offset this debit and the credit if it's for the same tax authority. However, in a group situation, even though it's the same tax authority, we will not have that legally enforceable right because we are dealing with different entities, different taxpayers. Okay, and then lastly, for current tax, the disclosure. So the disclosure of current tax in the note, you are familiar with that. It's just the foreign withholding tax that we have now added to that. So that's your FRK 201 knowledge. But there's also a part 2. So this is only part 1 of the note. There's also a part 2, which is your tax rate reconciliation. And you'll find those requirements in paragraph 81. That's your part 2 of the note, which you have not done before, which we will be doing in FRK 300. And I advise you to start loving that tax rate reconciliation because that is the test of whether you understand deferred tax or not. Okay, so there's, you are familiar with part 1, and then part 2 will be explained to you at a later stage when we get to deferred tax. So in lecture 1, what we have done so far is we did some revision of your FRK 201 and your BEL 200 work. And then we also looked at, in the standard for current tax, the objective, the scope, the definition, and the measurement. Your homework now is to make sure that you have that warm, fuzzy feeling for current tax. Go through all the paragraphs in IAS 12 that we have now covered. You also have to do question 1, parts A and B as homework before tomorrow's lecture.